I want to welcome you to another edition of Mentor Moments. My name is Paul Martin. I'm the Director of Academic Content at the National Alliance for Insurance Education and Research. And I'm joined today by my friend and colleague, Jim Gavin, who has been with the Independent Insurance Agents of Texas for many years. And we've gotten to work together, and I really respect him for his knowledge and his experience. Jim, welcome.
Thank you. It's good to be here.
Well, Jim, today I want to talk a little bit about the way insurance is regulated and the need for regulation. Well, that's a good question to start off with. Why does insurance need to be regulated as it is?
Well, the obvious answer is consumer protection, but the reality of the situation is even regulated, there are thieves in every business, and regulation just kind of makes it a little more difficult and gives a way to prosecute those people that are dishonest, basically.
Are you saying that there's a lot of opportunity for people to be dishonest in insurance?
No, what I'm saying is there's a lot of money that changes hands in insurance, and that money can be a huge temptation. That's probably the best way to phrase it.
It is a big pile of money. I did look up some numbers recently. In the insurance industry, including property and casualty and life and health insurance, is over $2 trillion a year. That is a lot of money. Mm-hmm. So consumer protection. So who is this consumer that needs protecting? Does a big company that's buying insurance need protection, or is it more for the small guy?
The good news is that if you're a big company is that the regulations apply to everybody. So if they're going to protect the little guy, you kind of accidentally get protected. But most regulation is geared at the average consumer who's buying homeowners and auto insurance.
And that's where a lot of the money is.
The theory is, at least the rationale is, that people buying business insurance are more sophisticated buyers. They should know better, basically, where the average consumer is not expected to know anything about their homeowners or auto insurance. And to that end, there is generally more regulatory effort trying to protect them than there is businesses.
If the audience doesn't know it, insurance in the United States is regulated state by state.
Yes.
Explain why that is.
The reality of the situation is that every state has different insurance needs and different insurance problems. In Texas, we have every natural disaster known to man except a volcano. To my knowledge, there's not a volcano in the state of Texas yet, but I think the legislature is trying to get one. But that's not the same in other parts of the country. It's a completely different kind of exposure in, say, Ohio or in Indiana. The ability to react to local conditions is what makes it the potential for profit available for insurance companies, which attracts them to do business in the state.
What's the old joke about if you're selling homeowners in Texas, you're just going to pay for roofs.
Yeah.
You're just going to because there's so many hailstorms. It's going to get somebody eventually.
I once had a customer say, "Why is my homeowner's insurance so expensive?" And I said, "Well, you're just prepaying for a new roof." And they went, "Oh, that makes sense."
Homeowners insurance is dramatically less in places like Idaho than it would be in Florida or in Texas.
Yeah, and part of the role of regulation is to not just protect consumers, but also to attract companies to those markets so they don't run out of companies willing to write business in those states. I think of what goes on in some states where they have requirements that if you're going to withdraw from the state, you've got to give 6 months to a year's notice, and then you're banned from returning for up to 5 years.
And it's a stability thing, isn't it?
Yes.
It's meant to be stable. Isn't it also true that the regulation from state to state allows for two things? Allows for experimentation of regulation, and it also prevents a contagion.
There's an organization of insurance regulators that gets together every year to talk about these issues. Part of that is not to nationalize it, but to kind of alert each other to what's happening in their jurisdictions, to see if anybody else has a solution for it or if they've addressed it. So there's shared knowledge across the states in terms of what's going on, but there aren't necessarily shared problems.
Yeah. Insurance, property and casualty insurance specifically, is bifurcated into two kinds of marketplaces, one that is very regulated and ones that is practically unregulated. Why is that, and how does that work?
We have these things called regulated companies or admitted companies, and those are folks who go into a state and say, "Hey, I want to write business in your state," and the state says, "If you'll play by our rules," meaning in many cases you'll file your rates with us for approval and forms with us for approval, if you'll play by our rules, we'll give you some benefits for doing that, basically. And most of the big companies that folks have heard of do that. That's the Travelers and the State Farms and the Allstates, and all those folks are all basically admitted carriers in the states they do business. Now, the second component of that is there's some companies that go, I don't want to play by your rules. I want to do what I want to do. And there's a way for them to do business in the state. They basically have to apply for the right to write business on an unregulated basis, for lack of a better way to phrase that. And they're free to do whatever they want to do. It really is the Wild West. They can charge whatever they want to charge. They can use whatever forms they want to use. And that sounds like a terrible thing, except that it isn't, because there's a lot of insurance innovation that happens in that situation. You know, that's where a lot of the cyber liability insurance products came from.
Sure.
Was the unregulated market, because they had the ability to change on a moment's notice and change the coverages on a moment's notice without waiting for state approval to get that done.
And there are also types of properties that the standard insurance companies don't want.
Yes.
Like you said, they want the best. But what about all those crummy 75-year-old houses in some city that nobody wants to insure those?
From an underwriting point of view, it's not desirable.
Not desirable is a good way of putting it.
Yeah, there are certain types of businesses that are both dangerous and specialized, for lack of a better phrase. And so a lot of companies don't want to risk their assets by insuring those things.
What are some of those industries off the top of your head?
Oil and gas is an example of that. Long-haul trucking is an example of that. You know, those are areas that have high exposure to loss, and it's kind of hard to get enough money to make that work. And it takes a lot of specialized expertise and, frankly, claims handling in order to make those things profitable. So a lot of that business ends up in this wild, wild west arena. Doesn't mean it's bad. It's just there are people who are specializing in those arenas.
Yeah, you think about, how do you get insurance for a circus? How do you get insurance for a rodeo?
Right.
You got to go to somebody who goes, okay, I'll do it. But those aren't the normal carriers that we see every day, but they can be. Speak to that. You can have insurance companies operate in both of these worlds, can't you?
Oh yeah, there are some insurance companies that are conglomerates, and they own multiple individual companies, some of which are in the regulated market or some are in the unregulated market, which just gives them flexibility to do what they need to do, basically.
Speak to the issue too about between admitted and non-admitted, these two worlds. The admitted are given, you said advantages, but those are some significant advantages. Talk about some of the perks of being regulated.
First of all, almost every state has regulations that say if one of the regulated companies is willing to write it, then the unregulated companies can't. So you have some market protection. The second one, which is even more important, is they get a preferred tax rate in most cases.
It's quite a bit lower.
Yes, and not many, even if you're new to the industry, you may not realize this, but every insurance policy includes a premium tax. It's not shown anywhere, but there's a tax in every premium that's issued. And that tax rate is lower for companies that are admitted and choose to play by the rules, basically, than those that choose not to play by, choose not to be regulated.
And those non-regulated companies, their tax rate can be 600-700% higher.
Yes.
Than the other insurance companies. It's significantly higher, that tax rate.
Which impacts their premium, which makes their premium higher because that is built into their ultimate premium cost. And I think there's one other point that's important to make. When we talk about the difference between admitted and non-admitted, we're not talking about companies that are financially sound and those that aren't. There are a lot of non-admitted companies that have all the money in the world. They just choose to operate that way.
Well, one of the largest insurers in the world, Lloyds of London,
yes,
is a non-admitted insurance company in most states for most things.
Right.
But they actually are admitted in some states, like for horse racing, because they want to be in that game. They've got to get in there and play with everybody else and have to be admitted to do it, to insure the horses and all that.
You talk about why there's regulation. One of my first things I did in the industry when I first came to this state was I had to go to a town in Texas where the agent had been collecting premiums and issuing fake policies for 3 years.
Wow. And
the reason I was involved was because I was working for an insurance company, and he was using our insurance company basically as saying, this is who's insuring your stuff. And it was kind of amazing, but when folks would submit a claim, he'd pay the claim for them.
covering his tracks.
He was covering. So we never knew what was going on until one day he was just gone.
He took off.
Yeah, with a little over $1 billion.
Wow. Did they catch him?
I don't know how that story ever ended.
Give me a good example of where there was huge regulatory change and it worked.
The easiest example in Texas is workers' compensation. We had a workers' compensation system in Texas that was so bad that every employer basically was placed into a pool and insurance companies were required to take their insurance. They didn't want to write any of them. The losses were terrible, and it was a system problem, and I'll give you an example of how bad the system was. At the time, I lived in Wichita Falls, Texas, which is a very small town, about 100,000 people. And in Wichita Falls, Texas, there were 3 attorneys who were making over $1 million a year handling workers' compensation claims.
Only workers' comp?
Only workers' comp. Not that many people got hurt, And the point I'm making is that there was some regulatory change, some legislative change, and what came out of that were 2 things. A more efficient system, improved benefits for workers, because that money that was going out of the system to other parties basically could now be used to pay better hospital benefits, increased wage benefits, increased death benefits, and that all created a vibrant insurance market where today we have one of the best workers' compensation insurance markets in the country, quite frankly.
Do you think the regulators in the states are doing a good job? Is it working out for everybody?
There are individual exceptions, obviously, but yeah, it's kind of a massive undertaking, and overall, I think they're doing a really good job. I mean, the fact of the matter is we have a vibrant insurance market in every state. It's affordable at this point in time, although, and that's obviously part of that equation. Insurance companies, even though some of them fail, most of them are successful, and I think that's a product of effective and successful regulation.
So, Jim, I want to thank you again for being on Mentor Moments with us.
Thanks for having me. I've enjoyed it.